On all of these shows, I like to start off the week, a summary of kind of what happened for the week within the stock market. So I'll share the chart here. And so we've been watching, this is going back to 2019. You can see the big drop there for the pandemic and then the big run up that happened. But if you look at what's happening here most recently, it's a pretty impressive actually. One of the things I like to look at is patterns,
Hmm.
within the kind of the charts and the stock market and what have you. And the thing that's striking about this pattern as a whole is just how smooth really this run has been.
Yeah, the last 2 quarters have been super strong.
Yeah, and it's pretty rare. If you go back, you can see smooth to the downside, right? Because
Hmm.
fear is a big, strong
Yep.
emotion, and so you look at that pandemic thing, that's pretty smooth. That went down 35% pretty fast. But if you look at just kind of, the other upturns, mostly there's a lot of, motion in there. The market tends to go up kind of slowly. So we're seeing a really strong market. And there's just so many indicators and so many pieces that are out there that are saying that this could continue also. We'll talk
Hmm.
about some of those. But it's sort of just a momentum thing. What happens is, it's kind of like a big ship. Once it really gets up to full speed and it's going in one direction, it can turn the other direction, but it's very difficult, takes time and what have you too. So that's what kind of propels this. There's always something, that can come out of the blue, like, a geopolitical event
Yeah.
or,
Yeah, there's always the black swan events.
yeah, there's always something that can stop even a big ship that's moving like a torpedo, basically,
Yeah.
right? I mean, so, but barring those, this market very likely will continue to do quite well for, the next 12 months even. And doesn't mean we won't have some pullbacks. I mean, last year we were up 26% and still had a 10% pullback, right?
Yeah.
We had two 9-10% pullbacks in 2020, and we were up over 20% that year also. So that's not that unusual. I mean, partly in a really good year, the market just kind of is flying so much, it gets a little overstretched, comes back down, but the buying interest is still there, and it kind of takes off again. So, uh, you know, there might actually be a correlation there between those pullbacks and a good year. But, this is a combination of, first of all, the Federal Reserve talking about lowering rates instead of
Hmm.
raising rates, inflation slowly but surely coming down. Okay, that's a big deal. The market loves lowering rates, right? It just does because it means the cost of doing business gets cheaper, right? In essence, and so profits can go up in those environments. Uh, we have a pent-up demand from the pandemic. Consumer sales came out today, and they were really good. January was down. They were blaming January on weather, so it seems like maybe that was accurate because February is back up again. And that's been the driving force all the way through here. We're supposed to have this huge recession last year, didn't have it, really because the consumers out there spending, perhaps they have money left over from some of the stimulus things, but really I think it's more of just an attitude of kind of carpe diem.
Yeah, 70% of the GDP comes from American spending.
Yeah, and that's one thing Americans are really good at, even at the cost of credit card
Yeah.
debt and what have you, which is kind of amazing. But you have other factors that are happening too. The government is spending. I read 447 billion this year on infrastructure. From those infrastructure bills. So that's kind of stimulative to the economy. The job market is very sound. Wages are still growing at a decent rate compared to inflation, overall on a year-over-year basis. So that's nice. And, it just makes people feel like they have more. And so this is a really fantastic market. I have a chart here going back a little farther. Um, so this has, going back to 1995. Let's take away the weekly summary thing so we can see. There we go. And you can see actually, and I'll put the arrows in here, kind of the last time we had this type of run and
Hmm.
this smooth, this steep was 1995. And so those are some of the other factors that are factoring in here. We have the pent up demand, kind of driving the market and what Congress did to kind of save the economy. And then we also have this artificial intelligence, and this is not something that's made up or what have you. I mean, you look at NVIDIA's earnings, it was unbelievable. That really kind of blew me away. Up 486% on their earnings over a 1 year period
Yep.
that's a big, big number. And when the earnings are actually going up more than the stock price, and the stock price is still up 200 and some odd percent, it's kind of
And
amazing.
the crazy part is they're not a small company
Nope,
either. It's not easy to generate revenue like that, that
no,
size.
No, I remember in the .com, it was Cisco was the picks and shovel type, piece that was coming in. But Cisco was fairly small at that time. They were kind of new with their routers, and you're exactly right. I mean, NVIDIA's been around for a long time, and they're not small at all. Matter of fact, now in terms of market capitalization, they're third on the S&P 500 and moving up actually,
Yeah.
probably at the rate they're going. So, uh, you know, I think we're kind of sort of in the early innings of the 95, run that happened. And it was a fantastic move altogether. Again, the picks and shovel stuff will take off first, and then kind of the more, I know, substantial IPOs. We saw Reddit come out, right?
Yep.
I think the IPO market's going to pick up. That's one of my predictions. It's been dormant for a long time. There's a lot of companies out there
Yep.
waiting. And they were jumped almost 50% their first day, and have continued to run also too. So there's some hope there that starts to take off. We'll start to see artificial intelligence companies coming in, and it kind of the rising tide will rise all boats, and you'll start to see this moving. I mean, this is the S&P 500 during the .com, which is predominantly dominated by big companies,
Yep.
and it still did really, really well. Ended up in the mania at the end, with the crazies, and that's what we have to watch for. And it ended up with a 45% downturn, still higher than where it started. But the stock market is a representation of human emotion, and when you get a whole bunch of humans in a crowd, we can definitely go too far both ways.
Yep.
There's just the way it works, and you can't really stop it. You just ride it and just watch for the crazy stuff. I mean, at the end of the 2020, run, really end of 2021 in the end, that was the SPACs, right? There was, if you watch the SPACs, you got different celebrities that people are putting $1 billion into these pool of money that they then get to choose what to do with it. And, a few of those probably worked out, but a lot of them are gone or close to it. So, those are the types of things we want to watch for at that point in time. Now, this was actually a stat that a friend of mine who's in the business also, his name's Chad, he's in the Midwest. This is a relative strength index. This is a very well-watched index. I mean, Chad and I talk about this thing all the time. And it goes back a long time. This has been around forever. It was developed by a gentleman by the last name of Wilder, so Wilder's Relative Strength Index. And what happens here is that the shaded area is basically between 30 at the low end and 70 at the top end. So it goes technically from 0 to 100. But if it's below 30, it's considered stretched to the downside, might be a good buy, right? If it's above 70, and then it's considered stretched to the upside, might be a time to take some profits, or be careful of buying at that point, right? Oftentimes, we are very careful with new money that comes in. We'll use this measure to maybe not buy when it's above 70, right? And you can see we had a tremendous run up there to basically, I think it went to 81 or something. But the stat that has come out was kind of discovered is that if you go back through the history of the stock market, when the RSI is above 50, and you can barely see it, but there's a little dotted line in the middle that represents 50. When it's above 50 for more than 80 days in a row, all right, trading days, this is a little over 100 now. It's only happened 6 times in the history of the stock market. And the 2-month, the 3-month, the 6-month, and the 12-month returns are all positive 100% of the time after this event happens. So this is just another one. This is like the Zweig breath, indicator. This is, there's just one after another. We just had 2 quarters in a row that will double digits. That's only happened 5 times since 1950. These are things that we're starting to stack on top of each other that just show the power and the momentum of where it's going. And it also shows, and this is something I believe in wholeheartedly, momentum's important. So once you have it, you generally keep it for a while. And that's why I still say, we should be running for a while, unless there's just some really bizarre incidents. They happen, unfortunately. But, barring that, I think this market continues to go. But I thought this was a really interesting stat. And of course, today was the reporting for the PCE inflation index, right? So personal consumption expenditure price index, right? This is the favored measure for the Federal Reserve. This is the core version of that measure where they take out food and energy, which is what the Federal Reserve is looking at. And so we have CPI, right? Consumer Price Index, which is probably more well-known inflation indicator. They don't pay as much attention to that. And then we have PPI, which is the producer price index, which is wholesale inflation. Those have already been reported. And so if you look at this, it came out today at 2.78% year over year. So versus last year at the same time. And still coming down. It was 2.85, last month. And so this is reported at the end of every month for the month prior. So this would be for March. And so they're going to get another reading before their next meeting. Right before, because their next meeting is the 1st of May, right? And so they're going to get another PCE measure here. And again, target is 2%. And the reason that the Fed is talking about, lowering rates at some point is because they're starting to see this come down. You can see, the big jump in inflation that happened, as everybody started to come back out. The government put out a $1.9 trillion stimulus bill at that time too, which probably was contributory to this. And now we're unwinding that as labor gets back out there and supply starts to come in. It will be interesting to see, because we had that big ship hitting the bridge in Baltimore, and see how that plays out, because that port's a really important port. Supply is important in an inflationary environment. So when you cut down on supply, I think there's like 800 and some odd thousand autos a year that go into that port, for example.
I think it's the number one auto port. It's a relatively, I think it's the 17th biggest port in the U.S. So it's not, but it is number one for the auto industry.
Yeah, and so I think they can get the port open a lot faster than build the bridge, of course. Because they can just clear the bridge out of the way, and the ships can start to get through there. But it'll be interesting to see what happens. We were talking to one of our clients yesterday, and he pointed out that they do use the bridge for transportation of, hazardous materials, which includes oil, and they don't go through the tunnels with those and such. So now they're going to have to figure out where that goes and how to make that work. So, all of these things, I don't know that it's big enough to cause a massive problem, but it is kind of interesting to see, what's happened there. So that's one of those kind of weird things that can happen that potentially has some impact. But if you look at, what we're having right now, the market is still expecting a rate cut in June. I think about a 65% chance of a rate cut in June. And so I still think that's early. And so do most of the Fed governors, actually, that get interviewed, because I think they're looking at more of that second half. Another meeting, so we have May, no expectation for cut in May, right, for the market. June, expectation. July, expectation. I wouldn't be surprised if they don't wait till September to start cutting rates, because we keep seeing the numbers come in, and they're pretty good, all right? And so it's a presidential election year. It's generally a good year for the economy, for a variety of different reasons, but we're seeing, I think, inflation numbers that are maybe a little bit higher than you would really want. The month-over-month inflation numbers we were looking at today for PCE, it was 0.5% for January and 0.3% on the core PCE for February and March together. That's kind of high, right? I mean, it annualizes out to 4.8%, but it's a little seasonal, I think. So we'll see how this plays out for the year. But anyway, really fascinating time, a really good time to be in the market, actually. Excellent time to be in the market. The returns, for the S&P 500 are in the 11% range just in the first quarter this year. That's a good number. So, we'll see how things play out for the rest of the year. Things are awful stretched out. On the RSI, which we just looked at, is around 67. So there's a little bit of room to move upward if it wanted to, in my opinion. But so it's not wildly stretched out. But still, it's amazing what's been going on. Every little dip. I've mentioned this in the daily videos. We've have now about 280 days, trading days, with no 2% drop on the S&P or more for the day. That's 280 days in a row. That's quite rare. The last time we had something like that was 2018. So we're starting to set some records there too. It's just it's a fairly smooth move and very strong. And even the quarter rebalancing that we had this week, because we were down, for the first portion of this week, we have the rebalancing at the end of each quarter. These big target date funds, if they're supposed to be at 60% stock and they're at 65 because they had a good quarter of stock, they're going to sell that and buy bonds or buy international stock or buy whatever is lower than target. And so there's oftentimes a sell-off that happens at the end of the quarter. That didn't happen, this time very much. They were all like 0.3% drops and just not much. Again, showing the power of this market right now. So anyway, that's our summary for the week. Again, a very interesting time. It's a good time to be learning. It's a time to watch and see how this works, and be ready and identify these kind of clues. To me, I'm looking at this a lot as like the dot-com bubble, and expecting hot IPO market and crazy stuff happening at some point in the future, and we'll start to make some defensive moves as we start to see those things happening. But it's still a good time right now. This is the heart of it. This is probably a favorite portion of this type of move. All right. So anyway, that's it for this week. Look forward to saying covering this again next week.